Welcome to the Deep Dive. Today we're taking a close look at United Rentals. They're the world's largest equipment rental company, and we're going to unpack their recent Q2 2025 earnings call.
Yeah, it's not just about the numbers, though. We want
Yeah.
to get into how a giant like this operates, how they're growing, and what it tells us about the wider industry.
Exactly. Our mission here is to give you that kind of insider view, the why behind the what. We'll cover the financials, sure, but also their strategies, customer focus, technology,
Hmm.
the whole picture.
And hopefully do it in a way that gives you clear insights without drowning you in jargon.
Right. So let's get started. United Rentals just reported Q2 2025, and the top line numbers look pretty impressive.
They really do. Record Q2 total revenue, $3.943 billion. That's up 4.5% year over year.
And the core rental revenue, that was also a record.
Yep. $3.415 billion for rental revenue. That's up 6.2% compared to last year. Strong growth there.
Okay, so revenue's up. What about profitability? I saw the adjusted EBITDA number looked quite high.
It was. Another Q2 record, actually. $1.810 billion. And that translates to a margin of, well, almost 46%.
Wow, 46% margin in equipment rental. That seems really strong.
It is. For a business this asset heavy, it says a lot about how well they're managing operations, pricing, the whole execution. And adjusted EPS came in at $10.47. Solid.
Definitely solid numbers. But you mentioned asset heavy. How are they doing with the actual equipment they own? I saw something about fleet productivity increasing.
Ah, good catch. Yeah, fleet productivity was up 3.3%.
Okay, 3.3%. What does that actually mean, though, in practice?
It means they're getting more revenue out of the gear they already have on the ground, better utilization, maybe smarter logistics, keeping equipment running efficiently. It shows they're not just relying on buying more stuff to grow revenue. It's about discipline.
Right, squeezing more out of existing assets. That's smart. Okay, so those are the headline figures. Impressive. But let's dig a bit deeper. What's really fueling this performance? Where's the strategic push?
Well, a really big piece of the story is their specialty business. Ah, the higher margin stuff.
Exactly. Specialty rental revenue grew 14% year over year. That's significant growth.
14%. Wow.
And they're backing that up with expansion. They opened 21 new cold start locations just in Q2.
Cold starts meaning built from scratch, right? Not acquisitions.
Right. Brand new locations focused on those specialty areas, and they're on track to open at least 50 this year. It shows a real aggressive push into these, higher value segments.
And is this growth concentrated or is it broad-based? What about their end markets?
It seems pretty diverse. They reported strong growth across both industrial and construction markets.
Okay.
On the industrial side, they called out power, metals, and minerals. Chemical processing as being particularly strong.
And construction. We hear a lot about infrastructure spending,
Yeah.
mega projects.
Yeah, they're definitely benefiting there. Infrastructure, non-residential construction showed impressive growth. They mentioned new projects kicking off data centers, hospitals, airports, those kinds of large-scale builds. Having that mix helps, It cushions them if one sector slows down. Makes sense. The one area that really jumped out at me from the call was the utility vertical.
Ah, yes. That's a fascinating long-term play they've been making.
They said it's now over 10% of total revenue, up from just 4% less than a decade ago. That's a huge shift.
It really is, and it's a great example of their strategy. They've been focusing on utilities since around 2016.
And the Yak acquisition back in March, that played a role too.
A significant role, yes. Yak brought in more capability in things like matting, pipeline services stuff that's essential for utility work. But it's more than just acquisitions. They gave this example on the call.
Oh, yeah.
They secured a 5-year deal with a major utility. And the way they did it was by really embedding themselves, understanding the utility's operations, offering solutions from across their entire range, cross-selling from basically every specialty business they have.
So it's not just renting a piece of equipment anymore. It's becoming a true partner.
Exactly. That partner of choice, one-stop shop idea.
Sure.
They want to be indispensable.
And technology must play a part in becoming that indispensable partner.
Right.
Right. That's all mentions of telematics.
Absolutely key. Their enhanced telematics helps customers work smarter. Think about the total control software.
Right. What does that do for the customer specifically?
It gives them complete visibility into the rental fleet, where the equipment is, how much it's being used, data across different job sites.
So the customer can manage things better on their end.
Precisely. Optimize how much equipment they actually need, cut down on, say, unauthorized use, reduce fuel costs, avoid overage fees. United Rentals said this leads to meaningful savings for clients.
Which naturally makes them want to keep renting from United Rentals. It builds loyalty.
Exactly. It fosters that repeat business and deepens the relationship beyond just price.
Okay, so strong operations, smart strategic growth, and specialty in utilities leveraging tech. Let's connect this back to the financials.
Yeah.
What does it all mean for their overall financial health and, for investors?
Well, one of the standout results is their free cash flow generation.
Right.
Really strong.
How strong are we talking?
$1.2 billion generated just in the first half of the year, and they actually raised their full-year guidance for free cash flow.
Oh, they did?
Yeah, now expecting $2.4 billion to $2.6 billion for the full year. They made a point of saying this ability to consistently generate strong cash, even throughout the cycle, is a key differentiator for them.
Right. Predictable cash flow, even when the economy fluctuates. That's attractive.
Yeah.
And what are they doing with all that cash? Shareholder returns.
A significant amount is going back to shareholders. Year to date, they've returned $902 million.
Okay. How's that split?
Mostly share buybacks, $667 million there, and $235 million in dividends. And looking ahead, they now expect to return almost $2.4 billion to shareholders for the full year 2025.
Wow. $2.4 billion.
Yeah, they translated that to about $37 per share, or a return of capital yield of around 4.7%. Pretty substantial.
Now, there was a specific reason mentioned for the increase in expected free cash flow and buybacks, wasn't there?
Yeah.
Something about tax policy, H.R. 1.
Yes, exactly. That recent federal tax reform, H.R. 1, is a big factor behind that $400 million increase in their planned share repurchases for the year, bringing the total buyback target to $1.9 billion.
So what does H.R. 1 actually do?
Essentially, it brought back full expensing for capital expenditures. So when they buy new equipment, they can deduct the entire cost from their taxes immediately instead of spreading it out over years.
Ah, so it lowers their cash taxes right now.
Precisely. Frees up more cash sooner, which they can then use for buybacks, dividends, or reinvestment. It's a direct financial benefit from that policy change.
Got it. So strong cash flow, boosted by tax changes, returning a lot to shareholders. What does this mean for their balance sheet? Do they have flexibility for other things like M&A?
Their balance sheet looks very healthy. Net leverage is down at 1.8 times, which is at the low end of their target range.
Meaning not too much debt relative to earnings.
Right. They basically said they have plenty of dry powder, lots of financial capacity. Total liquidity is around $3.0 billion.
So M&A is still on the table.
Oh, yeah. They said M&A remains a core strategy, and they have a robust pipeline. But they also stress their discipline looking for the right strategic fits that offer good returns, not just doing deals for the sake of it.
Okay, that makes sense. So financially strong, strategically focused. Let's shift gears a bit. How are they navigating some of the current market dynamics? Like I saw some notes about ancillary revenue maybe impacting margins.
Right, that's an interesting point. Their ancillary and re-rent revenue, think delivery fees, services, renting gear from others, actually grew faster than their own equipment rental revenue. About 10% growth versus 5.4%.
Which sounds good, but lower margin.
Generally, yes, especially things like delivery costs, which were likely higher partly due to integrating the Yak acquisition and just moving fleet around to support all that growth.
Right.
So while those services add value, they did dilute the overall rental margin slightly.
How much dilution are we talking?
They quantified it as about 100 to 130 basis points of compression, so roughly 1 to 1.3 percentage points off the rental margin temporarily.
Okay, but they expect that to ease.
Yeah. They said they expect that impact to decelerate in the back half of the year as things normalize.
What about the used equipment market? Selling off older gear is part of their model. How's that looking?
It seems to be stabilizing. They sold $317 million worth in Q2. The margins and recovery rates, how much of the original cost they get back, both improved compared to Q1.
So, healthy demand for used gear.
Looks like it. They called the market healthy and see it stabilizing after some of the, post-COVID weirdness. They're on track to sell about $2.8 billion worth of original cost equipment this year. Industry discipline seems okay too, which helps prevent flooding the market.
Okay. And inflation. It's still a factor everywhere. How's that hitting them?
They acknowledge it's a relatively inflationary environment. It shows up in things like those higher delivery costs we mentioned. Plus, they're actively investing in the new specialty locations in technology.
So costs are up, but are they managing it?
They framed those investments as smart choices for future growth. And, importantly, they said they're managing price versus cost effectively. Suggests they have the pricing power to largely offset those inflationary pressures.
That brings us to maybe the biggest trend. Rent versus buy. You hear about it all the time. Do they still see that shift continuing?
Very much so. They believe rental penetration still has significant room to grow.
Why is renting becoming so much more appealing now? It feels like a real structural shift.
Well, think about it from the customer's perspective. Renting offers flexibility. No massive upfront capital cost, no worrying about maintenance, storage, disposal, depreciation. You get access to the latest, safest equipment when you need it.
And you offload a lot of hassle and risk.
Exactly, especially with complex projects. The rental industry, particularly players like United Rentals, has become so professionalized. They act as reliable partners, helping clients be more productive and efficient. For many customers, it just makes more sense than owning.
Yeah, I can see that. So looking ahead then, beyond 2025, what's the vibe? Are they optimistic?
Definitely sounds like it. They expect continued profitable growth. They pointed to ongoing tailwinds from those mega projects we talked about, the power sector build-out, infrastructure spending.
And customer confidence is holding up.
Seems so. They said feedback from customers remains at high levels. And they also mentioned some broader potential positives, things like post-election stability, the ongoing benefit of that HR1 tax reform, maybe the Fed eventually becoming more accommodative with interest rates, all things that could encourage more investment.
Okay, so summing this all up, this deep dive really paints a picture of United Rentals as a company firing on, well, quite a few cylinders.
Yeah.
Strong financials, clear strategy, adapting to the market.
Yeah, they're not just dropping off equipment, they're integrating deeply with customers, using technology smartly, managing their finances with discipline. It's a sophisticated operation.
It really is.
And, connecting this to the bigger picture, it makes you wonder, given how much they emphasize being this integrated partner of choice, using telematics, cross-selling everything, how much further could this go? Could equipment rental companies evolve even more, maybe becoming almost like outsourced operational partners for certain aspects of a client's business, managing logistics and efficiency way beyond just the physical assets?
That's a really interesting thought. Moving from equipment provider to a much broader service integrator, something to definitely keep an eye on as these industries evolve. Well, thank you for joining us on this deep dive into United Rentals. We hope you feel better informed, maybe ready for that next meeting, or just satisfy your own curiosity. We'll catch you on the next deep dive.